Welcome to my very first episode of my new podcast. I'm here today with Mike Souza from Co-Wealth. Thanks for coming on the show, Mike.
Thanks for having me, buddy.
Yeah, dude. I'm super excited to be starting off this podcast, especially with someone like yourself. I want to give a little bit of background on why I'm doing this because, this is a first episode, but we are now going to be moving into a podcast segment where I'm going to be interviewing influential people in our community. Most of these guys are guys I've known for a while, different industries. The goal for me is to provide informational, educational tips and tricks on a myriad of topics to people, that follow me, that know me in my sphere. The goal is to really just, have some fun, have a good time and just, again, educate the community on different topics. I'm going to be bringing on different industry leaders that are experts in their craft. Here today with Mike. He is in the financial wealth management sector. And, we've been friends now. How long, Mike? About 6 months?
Yeah, about 6 months now.
So yeah, we met and kind of hit it off right out of the gate. I feel like we're very similar creatures.
My brother from another mother.
That's right. Yep. Both got large families, beautiful wives. Our families mesh well. In fact, we've already taken a vacation together, which was a lot of fun.
Absolutely. Havasu.
That was a good time. So yeah, if you don't mind, Mike, can you give me just a quick kind of overview, a little background on yourself and, what you do for a living?
Yeah, absolutely. So I'm the CEO, founder, and lead advisor at Co-Wealth Management. Our office is out of Carmel Valley here in local San Diego, and started the firm 4 years ago. But previous to that, when I moved out to San Diego toward the end of 2002, I started in the wealth management training program at UBS. I was stationed out of La Jolla office there. And, was a top performer in the training program, became one of the youngest sales managers here in San Diego for the firm at 27. And, spent about 5.5 years there. And while I was there, partnered with another advisor who became a very good personal friend. And we transitioned our business to Morgan Stanley, where we were there for about 10.5 years in private wealth. And then eventually I decided to break out and start my own firm. Really for the main focus of what we do today, which is helping families kind of manage through the difficulties and the questions and issues that they have around trying to build permanent wealth and really trying to build multi-generational wealth. So it's a lot of what we do, a lot of what we focus on, and one of the main reasons why people come and work with us.
Well, I mean, I met lots of financial planners in what I do, day in and day out. And obviously we're in similar, fields. We deal with people and finance and money and, helping them make decisions on how they're going to improve their lifestyle. And I got to say, you're definitely that top tier of financial wealth advisors. I mean, I've interacted with, hundreds of them in my career. I've been doing this 20 years. And it was very apparent to me when we first met, went out to breakfast that morning. You know what you're doing and you're actually starting to help me out with some of my stuff, which is cool. I appreciate all you're doing for me and my family. So,
absolutely.
Well, let's get into a couple of details here. So, there's lots of strategies out there. There's lots of different ways to kind of tiptoe into managing someone's, financials and helping them create a plan. What are some of the strategies or tips that you like to start out with when you're first introducing to a new family?
That's a great question. I think about, I like to use analogies with clients, right? I find that if you can kind of paint them a picture, it helps to demystify the financial world and break things down to simpler terms that people can relate to. So whether it's, I want to use a sports analogy of kind of learning how to block and tackle, right? Like in football, the basics, or like a house. If anyone's ever, built something, you want to start with the foundation first and then kind of put up the walls, the roof, and then, the furniture and all the rest of it. So I think, again, speaking to people in a language that they can understand, kind of unjargoning the financial world, I think is very important.
It can be complicated. People get kind of caught up in all the details. You got to just keep it simple.
They do. And at the end of the day, it's about building trust, right? And building trust means that both parties have to be on the same page. I'm 20 years in the business at this point. People expect me to be competent, so I don't spend a lot of time trying to show them how smart I am. I'm kind of past that point in my career, maybe at 23.
It comes across real well that you know what you're talking about.
But I really just want to break it down, keep it simple. So what we always do is we say, look, everyone always asks us about the investing side of the ledger. And I get it. It's sexy and interesting and everyone wants to make money. That's how we're compensated. And that makes sense. However, what we always try to remind people is the investments are a means to an end, right? What you really want to understand is where are you trying to go and in what kind of time frame. So we really kind of back the truck up and start at the beginning, right? The foundational piece of everything we do with our families and our clients is starting with financial planning. And that's a very general term, but what it focuses on are all the areas that are a part of a family's life, right? Because it's about protecting your wealth. It's about growing your wealth. It's about transferring your wealth. It's about understanding how to use debt properly and appropriately, understanding insurance, estate planning, taxation. So there's all these different pieces that need to tie together that really help optimize a family's financial situation. So for us, we start with the planning. We break down each one of those areas. And we focus on sometimes very simple things that people forget to do. Budgeting is a classic one, right? Most people, 90% of people we run into, we ask them, hey, do you know how much you spend every month? And they give us the blank stare like, I have no idea.
People just fly by the seat of their pants.
You know, they're like, well, I make good money. All my bills get paid. I'm fine. And I'm like, fair, understand that approach. And then I tell them my own anecdotal story years ago. You know, I was working, wife was working, we had lots of income coming in and again, the bills were getting paid every month, but I had a sense that we weren't probably saving as much as we could or we should, but I didn't have any data to support that. It was just kind of a feeling.
Right.
So actually during the holiday season, I went back to Jan 1, right, and reconciled all the bank statements and credit cards, put it all in an Excel, and actually found out that we were spending roughly $1,000 more every month than what we were bringing in.
Wow.
But I couldn't see it because of the cash flows coming in and out, the numbers and all the rest of it. And so just by focusing and being aware of that, the following year, we went from a deficit of $1,000 a month to a surplus of $7,000 a month, right? An $8,000 delta.
That's huge.
And so, and it wasn't huge, massive changes. It's not like we went from, you know, eating out at steak dinners every night to staying home eating tuna fish sandwiches. It wasn't anything like that, but it was just being more aware and being more cognizant of here are the choices we're going to make.
Yes.
And again, just tracking that throughout the year. So I tell every client, you know, whether you're making 100,000 or $1 million a year, it's something that, you know, we want to come up with a budgeting strategy, either intricate or simple, but you really need to know where your money is going first before you can figure out what's realistic to say, I can save, or I can do this, or I can execute on that. So again, starting with the basics, building that foundation, and then, you know, adding to it over time.
I love the budget analogy because I mean, you know, in my world doing mortgages, you know, we're looking at debt to income ratio. We're looking at how much money you make, how much money is on your credit cards and all those other expenses that you have on a monthly basis. So we kind of are doing a very high level budget for people. But what you're talking about, where you go very granular and being able to, you know, it's cool with technology today. You can go into any of your credit cards, or you can go to even your Amazon account and see where you're spending on Amazon, and you can drill it down and drop it into a spreadsheet and really study the math. And that's where, again, you find those segments. You're like, wow, I'm spending X amount over here. You know, I've done that same exercise with my household, and it's mind boggling sometimes. I mean, you find all this stuff where you're spending money, not even realizing it, on subscriptions. Like, you know, you've got, you know, multiple music, you know, Pandoras and Spotify's and all these extra accounts where you're just, you know, kind of wasting money, and you can trim the fat in so many areas if you just sit down and study it and spend that, you know, a couple hours or whatever it takes to dissect the math. So it's huge. So you help your clients do that.
Absolutely. So, you know, again, we have budgeting tools. We use a platform called eMoney, which you've been recently exposed to.
Very cool.
Where, you know, clients can store financial documents in an encrypted vault. They have a dashboard where all of their different assets and accounts can be linked up, so they can actually see their net worth kind of going up and down on a daily basis.
That's a little dashboard
if they want to. And then it also has a budgeting tool. It's very similar to, you know, a lot of people are familiar with Mint, right? Which is a product from Intuit, where you link up accounts and it starts to track your spending and categorize it for you. So again, it's, you know, as people are responsible for their own success, right? Success is a choice. It's not an accident. In any part of your life, whether it's your career, your finances, your relationship with your spouse, your children, right? It's the choices you make every day accumulate into something good or something less than optimal. And so we just tell people, look, I mean, we want to help people get focused. We want to help people get accountable, right? Your results are going to be exactly what you put into the process.
I love it. I love it. you and I were having a conversation. I think you might have started it when we were out in Havasu about strategies like Roth IRAs, right? And a lot of people don't necessarily understand them. They've heard the term, maybe they have one, kind of hands off, don't do a lot with it, but it's an excellent tool that a lot of people either, again, maybe utilizing. But let's talk a little bit about Roth IRAs and some of the strategies that you guys like to implement with your clients.
Yeah, we're huge believers in it. Probably about 12 years ago, I read a book by a gentleman called Ed Slott, and he's kind of an IRA expert within our industry. And he really spent a lot of time within the book focusing on Roth IRAs, how they can be utilized, and how the compounding of assets in those accounts can really help families, again, build permanent multi-generational wealth. What people forget is, if they have $1 in an IRA, it's not really $1, right? You're going to have to pay income tax on that at some point, right? So it might be 70 cents, 60 cents, depends on what your tax bracket is, but $1 is not $1. In a Roth IRA, $1 is $1. When you eventually make those withdrawals to use that capital, you do not pay tax on it. And in the meantime, every year, those dividends, interest, capital gains accrue and compound. They're doing so on a tax-free or frictionless basis, right? So we always look at, how can we help our clients get capital into those accounts? Now, the difficulty is there's a lot of rules and restrictions around funding them. So if you're a high net worth individual, you cannot contribute directly to a Roth IRA. You are phased out from an income standpoint. Right. So the other strategies we look at are, number one, most employers offer a 401k and they will have a Roth option. So what we'll do is we'll run the math of saying, okay, if you were to do a pre-tax option with this amount of contribution versus a Roth option, you'll take a tax deduction on a traditional IRA now, right? But you'll have to pay tax potentially on a much bigger number that accumulates later. Or do we want to pay the tax as we go now, let that money grow and compound into a big number and be tax-free? So we show clients the math, right? Like I'm an engineering accounting type brain. Like you can tell me the concept works, but I'm like, great, show me the evidence.
Show me the math.
Show me the math. Math doesn't lie. Right?
Don't give me the answer. I want to see your work.
Exactly. So we run the math for them. We put it in front and say, here's what we're suggesting and here's why, right? And so once they see the data, they're like, cool. So a lot of times we're switching clients now and suggesting that they make contributions to a Roth 401k. I'm even doing it myself. My whole career up to this point, I'd always done fully tax deductible contributions to a traditional 401k until January of this year.
I'm guilty of that.
And the reason is I was like, hey, I've got, high income. I need the tax deduction. And so I've been doing it, and that makes sense. However, when I started looking at it again over the holidays this past year, I looked at what was in my 401k and I said, all right, let's say I take that capital and I compound it at 7%, which is not a crazy return. No. Over the next 30 years. I'm 43. By the time I hit 72, I'll have required minimum distributions. That capital can double 3 more times. And so I looked at that number and said, wow, well, if that number does double 3 more times, I'm going to have this very large number in a 401k, and I'm going to have massive RMDs that I'm taking every year, which are pretty much going to put me in the top federal bracket before I do anything else. Right. So I looked at that and said, okay, well, I've already accrued what's going to be a pretty large tax liability here. I want to now start building up this Roth side of the bucket. Right. So I've switched some. Yeah, so I've already done the pre-tax for years. Now I'm going to focus on the Roth. And what investors need to also realize is the deferral portion they put in as an employee, that portion is Roth. Anything your employer is going to put in, a matching, a profit sharing, that's always going to go into the pre-tax bucket because your employer wants a deduction, right, on that contribution. That's part of why they're making it, right? They're trying to reduce the income for the entity. So that's what we'll do. We'll use the 401k as a Roth conduit. Now, there's also another strategy called a backdoor Roth funding strategy. Okay. No matter how much
Roth funding strategy,
backdoor Roth funding strategy. I know it sounds a little cheeky, but what it is there are no income limitations on making a non-deductible contribution to a traditional IRA. So if you wanted to make a deductible contribution to an IRA, you have to have your income under a certain limit, which is fairly low. Again, most high income earners are not going to qualify for that. So what we tell our clients is, look, you can make a non-deductible contribution to an IRA, traditional IRA. Then there is no income restriction on taking that contribution and converting it into a Roth. So it's a 2-step process to get money into a Roth IRA. perfectly legal, right? It is all within the tax code. And if you're making a non-deductible contribution to the IRA and then converting it to the Roth, there's no tax on the conversion. Why? Because you're using post-tax dollars to make that contribution.
Correct.
And then when you make the conversion, there's no taxable event. So you'll get a 1099-R, right, on that distribution. You'll get a 5498, which basically says, hey, my Roth received the money. The IRS gets all of that information. What you want to make sure you do is when you make that non-deductible contribution, this is the part that people slip up on. You got to let your CPA or your tax filer know, because there's a form 8606 that has to be filled out. Think of it as like a record keeper of all your non-deductible contributions that you're making. So if you ever get audited, right, the IRS comes and says, hey, you've got these 1099-Rs, how come you didn't pay us tax? You can say, hey,
here's my books.
Here's my books, right? Here's what I made in non-deductible contributions. I then went and converted those. I don't owe you any tax. Have a nice day.
You help your clients then with that process of like the conversion and the record keeping and like kind of communicating through with the CPA.
Absolutely. So we'll send the CPA a note, let them, we'll get the contact information for all our clients' tax people. We'll send them a note. Hey, we're doing this right now. So they're in the loop. It's in their records. And now it's on them to remember to do the filing. The other strategy that we'll do, and this is more tactical, is you can take, again, a traditional IRA, and let's say in a point in time like right now where the market is depressed in value, right? We've had 25% drawdown in the NASDAQ. We may look at times like this and say, hey, while your assets are depressed, maybe we want to take them and convert them. And we can choose whatever amount. We could say 10 grand, 100 grand, we can pick whatever it is, but take those assets and convert them now into a Roth IRA while the values are depressed. So you'll pay tax if they're pre-tax, assets, which generally they are, you will pay tax. But now eventually when the market recovers 12, 24, 36, whatever, over time, when those assets reflate, they're now reflating in a tax-free account, right? Which is exactly where you want that growth to happen. You really don't want the growth to happen in that pre-tax account, again, because you still are going to have to pay income tax on that at some point.
Love it. Love it.
So
let's shift gears for a minute. Let's talk about, a big number, right? So home equity in America is at crazy levels right now, right? Home values have appreciated at record numbers. The current statistics show that there's $26 trillion in America in equity, which again, that number is just mind-boggling to me. So, we're starting to find with what we do in mortgage that, people have so much equity, they want to leverage some of that, whether it's into renovate a house, to invest in other real estate. I'm a big believer in that, taking the equity position in say your primary home, tapping that with a home equity line of credit, for example, using some of that to go and buy additional assets that will continue to grow your portfolio and your net worth. Do you guys, obviously, a financial advisor, I would assume doesn't appreciate when you've got your portfolio and your client calls you and says, hey, I want to take 500,000 or 300,000 out of my investments and go buy real estate. So if you can double down on the equity in your home by using a line of credit and maybe going and applying that into other real estate endeavors, other properties, what have you, is that a strategy that you work with your clients on? Or, I guess my question is, what suggestions would you have for people that have a ton of equity in their house today to tap it and maybe even put it into other investment vehicles?
Yeah. So great question. So it's interesting, personally, I bought a home in October of 2020. As soon as I was, able to put a HELOC, a home equity line of credit on it, I went through the process and got that approved. I think, and again, I'm a business owner, right? I have an LLC and S Corp. I've got to manage all the cash flows in and out of that, as well as the household every month. There's a lot of moving parts, a lot of spinning plates.
Absolutely.
I tell any one of our clients, if you're a business owner, or if you're a professional, like we deal with some very high-powered attorney clients, they're partners in firms where, the way their businesses work is they get big chunk payouts, right? Maybe at the end of the year
distribution.
Yeah. So the business owner may say, hey, I'm going to pay myself some minimal salary. And then once I get to the end of the year, I'm going to pay myself a big K1 dividend. So they might be liquidity strapped, and then bang, they get this big number. Same thing with attorneys. They're usually taking a draw. And then maybe if the firm does really well, they get a big bonus at year end. So but a lot of times they'll have phantom taxes that are owed kind of along the way. The business owner has to make their quarterly estimates. That attorney has to make their quarterly estimates. So
they're cash strapped.
Oh my God. So they're making payments on money that they're going to receive, but they haven't received, right? So you can either keep a lot of cash on hand That's one strategy. Or the other is to say, look, I want my money invested. I want my money working for me. I want to utilize credit lines, right, as a way to kind of bridge that liquidity.
Sure.
And knowing that I'm going to get that capital within a reasonable period of time. So I'm not paying, a ton of interest and I'm able to pay it off. So I think credit lines at a minimum, right? So as a foundational tool are a great way to give you access to liquidity.
Absolutely.
And even a client who says, I'm not an attorney that has a cash flow issue or a business owner, I tell them, you know what, why not put a HELOC on your house?
Have it there, safety net.
It costs nothing to set it up, right? And for most institutions, if you cancel it within the first 3 years,
pay like $300.
You'll pay a $500 fee to cover
nothing.
the appraisal that was done.
Right.
That's it,
Big
right?
deal.
But you've now got this line of credit. You can choose to draw on it whenever you want to.
Right.
If you draw on it, the payback terms are highly flexible. Generally, you just have to service the interest every month.
Right.
You can pay back the principal whenever you want to. So it gives you a lot of options. And the biggest thing you always want is access to liquidity, because things happen in life sometimes unexpectedly. And what you don't want to be doing is using expensive sources of credit, like a credit
You
card.
don't want to use credit cards to, like, pay your bills or
Yeah.
whatever, try and survive.
Yeah.
Having that cheap line of credit, quick access, it's like a checking account. It's so much better.
Credit card at 21% API or my HELOC at 4.
Right.
It's just
No
math.
brainer.
Just
No brainer.
math, right?
Yeah.
Simple. I don't gotta be a genius to figure that one
So
out.
the takeaway here is, what you buy a house, right? You have the equity. A lot of people have a ton of equity, is to put a line of credit, even if you don't need it, just to have that safety net, have it as a reserve tank so that you have it to tap into if you need it for, like you said, cash flow issues.
Or even just bridging yourself. So a lot of times what people run into is, again, especially if you're a younger couple, I've bought a home, I've accrued equity. Now
Sure.
I want to move up and I want to buy a bigger home. Well, the
Right.
problem is to kind of facilitate that transaction. Where's the
Right.
down payment money going to come from? Right.
Exactly.
So am I going to sell my house and then rent for a period of time and then buy the other? I mean, it's kind of it's a logistical kind of nightmare. And so what we'll tell clients is fine, take a HELOC out, right? Use that money as your down payment, right, on the new place. Get into that, get yourself moved, right?
Have reserves to be able to maybe cover both mortgages, even use the line of credit to kind of cover the bases for the short term.
Complete that process where, okay, I'm going to get my buy side. I get myself moved over. Now I can focus on the sell side.
Right.
It's hard enough. Anyone that's bought or sold a home knows it's hard enough to handle one transaction at a time. But if you're trying to sell buy simultaneously, dude, stressful, highly stressful. I just did that again 18 months ago. And I mean, we threaded the needle where we got, the house sold like 48 hours before the buy went through.
Oh, it happened. The concurrent close, it's a nightmare.
It worked out, but I was like, never again. I'm not doing this again. So, so there, again, use that tool, right, to help you with transitions like that. So
Totally.
I'm a big believer. Debt, when used appropriately, is a wonderful and useful tool. Debt, when it's used inappropriately, where you get yourself over levered in a situation and you can't service payments and you're handing back keys, that's a problem.
Yeah, robbing Peter to pay Paul, or shifting money from your left pocket to your right pocket in a bad environment, covering debt with debt. That's a no-win situation.
Drawing on my HELOC so I can go take that killer Vegas vacation.
Yeah.
Or to go buy that Ferrari, which is the depreciating asset, or whatever.
The jet skis, whatever.
Yeah, those are not great decisions, So again, it's every situation is different, right? Nothing is 100%, the same. But for the people, and again, as a philosophy, my father's 77. He has a mortgage on his house, not a huge one, but a decent one. And I look at it as, my father has always been of the mindset of, I don't like debt, right? I'm like debt phobic.
It's definitely the way of that generation.
Yeah. And
pay off your house, be debt free.
Yeah. My dad grew up, with not a lot. My mom grew up on welfare, more or less. So I understand where they come from. However, I tell my dad, I say, look, the amount of debt that you carry versus your overall balance sheet, you're 7% levered.
Yeah,
you're going to be okay.
You're going to be fine.
Like, you can service that payment. And he's borrowing capital at 2.75%. He's getting a deduction on the interest, which means his effective rate of borrow or carry is around 2.
Right.
So if we can't take that amount of money and invest it somewhere else, real estate, stocks, whatever, you pick them.
Yep.
If we can't net better than a 2% after tax return,
right,
I need to go get another job.
Absolutely.
Right. I need to sell my firm, be like, peace out. I'm not very good at this. I'll do something else. So, and that's the fact of the matter. So leverage is okay if used appropriately. And so my father, right, through kind of talking and education is saying, hey, I don't need to have the house paid off by the time I pass away. If there's still a loan on it, guess what? That's Mike's problem.
Yeah.
He'll deal with it.
Sell the house, pay off the mortgage.
Yeah. Whatever. You know what I mean? So, but utilizing leverage appropriately to increase your returns, to build your net worth faster. And that's where, again, partnering with a mortgage advisor who is going to look at your situation and say, hey, this is appropriate for you to take out this kind of loan. The people that I refer business to, like you, Nick, and other lenders in my network, are the people that I trust, or the people that say no. Right? Someone comes to you, look at your situation and say, I hear what your idea is, but I'm going to tell you why you shouldn't do this. Here are all the things that can go wrong that maybe you haven't quite thought through, you know, as fully as you should. And, you know, if you were a family member of mine, a sibling, a parent, what have you, I'm giving you the same advice I would give them. Right? Like, and this doesn't get me paid, right? I would love to do the mortgage. I'd love to get paid.
But it's the wrong decision.
But it's the wrong decision. And my number one fiduciary responsibility is to take care of you and do the right thing for you.
That's the only way to run your business. I run my business.
That's how you take care of people, right? I mean,
take care of people, and it all works out.
It all works out. It all works out. Because that person will say, you know what? No one's ever told me no. And guess what, Nick? I got 3 people I think you should call.
Totally.
And that's how we build our business.
So let me ask you this. So let's say there's a couple that's maybe a little bit older, they haven't started really building their financial plan. Obviously starting young is the best strategy ever, right? I mean, start, when your kids are in elementary school and putting a few $100 aside for them and kind of starting to grow their 529 plan or whatever. But let's say you didn't do that. Now you're in your 30s or even hitting 40s, and you don't really have any money set aside for retirement. There's no 401k, there's nothing going on. What steps would you recommend to hopefully help someone kind of get on a path? Because you know this as well as I do, that there's a lot of people approaching retirement age, mid 60s, 70s, that they cannot take care of themselves. They do not have a plan set up to be able to provide for themselves. And they have to rely on, their working children in their 40s to support the seniors.
Yeah, absolutely. I mean, it's shocking, some of the statistics that we read of the percentage of Americans that live below the poverty line, or the average amount that Americans have saved for retirement. Shocking. I mean, it's a much lower number than you would expect or you would think. So
most people can't live on their Social Security. I mean, it's such a small number,
and it's not intended to. And it's funny. So Social Security, and I always joke with clients, and there's truth to this, but it's the world's largest Ponzi scheme, right? Because the people that started collecting it in 1933, never paid into it. Right. The people who were working were the ones paying in to fund it. And the people that were already of age to qualify were receiving it. So it's the world's oldest Ponzi scheme.
It's crazy.
It is what it is. So, but the reality is Social Security is it's really only intended to cover maybe 30 to 40% of your living expenses. It's not intended to be a real pension where we're trying to cover all of your costs. Right. So people have to know going in that, again, that's a foundational asset that they hopefully can count on, right? You're going to get that check every month as long as you fog a mirror, right? As long as you're alive, you're getting it. And so what we always tell clients is Social Security, a lot of people, when they come to us initially, their thought is, well, I want to take that as soon as possible because I want to start collecting on all that money I've been paying in for the last 40, 50 years, whatever, right, of working. And we say, I get that. That makes logical sense. However, how we want you to now think about Social Security is not how much can I collect before I die, but how high can I get my payment in the event I live too long? What are you gonna do if you live to 100? People are like, there's just no way, Mike. There's just no way. I'm like, well, let me drop some knowledge on you. Fastest growing part of the populace are people turning 100 as a percentage within the country. Yeah. So, I mean, look at all the look how fast we whipped COVID. Right. I mean, the technological advances, other than your brain, they haven't quite figured that one out. I mean, if your brain goes, well, good luck. But anything, organs, physical, bones, whatever. I mean, it's like going into the auto shop and getting a new set of tires. I mean, they'll just keep you running, whether you want to or not. They can keep you alive longer than you will think. And that life expectancy will continue to go up. So we think about Social Security as just longevity insurance, right? Don't think about, if I die at 70, well, guess what? You're dead. So don't worry about anything anyway. At that point, you have no financial responsibilities. But what if I live to 100 or 105 or 110? Not statistically, it's not a high probability, but if you do, you want to make sure that, hey, I'm going to get that check coming in every month. So we'll tell people, if you can wait till full Social Security age, which for most people is 67, do it. If you can wait till 70, which is really where you max out, definitely do that. Because the other thing you have to think about is this. In a lot of households, there are 2 spouses. One is a high income earner, could be the male or female. and the other one generally makes less money.
Sure.
Well, when one of them passes, and it doesn't matter either one, their surviving spouse gets to keep the higher of the two Social Security payments, right? So if the higher income earning spouse waits till 70 and they've maxed out whatever that payment is, right? If they die and they leave their lower earning spouse to survive them, that lower earning spouse is going to get that higher payment. At least they'll keep that. They might lose their smaller Social Security, but at least they'll keep the bigger payment. So again, it's not only about protecting your longevity, but also if you're married, your spouses, right? And you and I, we have wives that do a wonderful job of taking care of the home front, but they're not the primary income earners in our household. So I want to make sure, and they're younger than us, right? They're probably going to live longer than us. I want to make sure when I kick the bucket that money's going to be there for her and she'll be well taken care of.
Awesome. It's awesome. Let's do a pivot to maybe life insurance for a minute, right? I mean, that's something you're actually helping me out with. I've got a ton of life insurance, made some choices about a decade ago that may or may not have been the right choices. And you're kind of helping me through that, navigating that process. What advice could you give around, what type of life insurance? I mean, some people say use life insurance as an investment vehicle. I was guilty of that and signed up for a very aggressive plan. There's the term insurance, obviously every person's needs are different. Right. And there's some people that one strategy is going to be better than the other, but let's talk about life insurance for a second. What's your opinion on, when you should get life insurance, best utilization of how to put a plan together?
Yeah, absolutely. So I'm licensed to sell anything and everything under the sun. I mean, I can sell any kind of insurance any person would ever want to buy in terms of life insurance. So I'm not limited by product or anything. What I always tell clients is this, and again, I like to kind of, I like to have some levity in these conversations. I tell them, look, I look at the Forbes 400 every year. I said that I haven't found a person yet that's on there because they own a ton of life insurance products. They might own a life insurance company, right? They might own that, but they don't own a bunch of life insurance products. So that's not the way people get rich, right? And I also tell people, just from a logical standpoint, if you look at the products, right, how the agents or brokers are paid to sell that product should tell you something about it. Right. We sell a lot of term insurance. Probably 98% of the insurance we sell in life is term. Why? Because it's the least amount of dollars that you have to put in for the maximum amount of liability coverage if you need it, i.e. I die before I was expecting to die, and I need this amount of money to replace income that I'm no longer here to earn, or to pay off debts, right, that are there for the survivors, my spouse or children or whoever, right, that I want to provide for. So getting that maximum amount of leverage, smallest dollars in for the biggest amount of benefit on the back end, I can pick the amount of time I want to cover that. Is it 15, 20, 30, 35 years, right? Generally term can be written out to about age 80. So you can have it till you're fairly old. Okay. But the idea is we think about it as liability protection. I'd rather take the dollars, right, the excess dollars that I could have put into a whole life policy, a universal life policy, a variable universal life policy, that excess money that sits in an investment bucket of an insurance product that's highly feed, right, is very restrictive to get out of the policy. They always tell you about, easy to get the money in, but it's like Roach Motels. It's hard to get the money out. They don't tell you so much that analogy. Part. Yeah, they just are, right? And they're very restrictive. I have a very limited pool of things I can invest in. If it's whole life or UL, they kind of kick me out an interest rate and that's it. If it's a VUL, I've got a 401k like product where it's some index funds, mutual funds, and how well are they run? What are the fees involved with them, et cetera, et cetera. So we always tell people, look, buy term and then invest the difference. Right. Go buy real estate, go buy your Apple, your Google, your whatever you want to invest in, right?
And let that grow.
And then run that side by side. Let's say, look, if you take this insurance product over 30, 35 years and you put together a well thought out portfolio and you look at the two, I like my chances on a well thought out portfolio of building a lot more wealth for the client. So, and again, I look at how you're paid. If I sell a client a UL, a whole life, a VUL policy, we get paid really well. If you ever look at what's called an in-force ledger, and it's going to be part of your packet when you sign up for insurance, look at that cash accumulation column. The first 4 years, you're like, well, I'm paying like 10 grand a year.
All going to the agent.
It is 100%.
A big chunk of it. Yeah.
A big chunk of it. Your cash accumulation value is like it's like a cancer patient. I mean, it's
Right.
hardly anything there. And the reason is they paid a huge commission to the agent.
Sure.
The insurance company is going to recoup that the first 3-4 years of cash you're kicking in. Then after that point, once that's recouped, then that cash will start to sit in the bucket and will
Sure.
start to accrue. So again, we will sell permanent life insurance when it's appropriate. We use it a lot of times for estate planning. So if a client has an estate that's going to be large enough that estate taxes are due, then we need to have a policy that will need to survive maybe longer than term, right? So if the client lives past 80, we got to have something that's going to kick out a liquid cash death benefit that will be income tax free. And if we
cover that.
Yeah, and if we house it in the proper structure, it can also be estate tax free.
Okay.
That can be used to pay estate taxes. So now the family doesn't have to sell that real estate or that business or that stock position or whatever the case may be. So again, we always look at it, right? It's client first, whatever's best for the client.
Perfect.
We don't worry about what we get paid. We do well already. I don't worry about that side of it.
They're not
but
driven by the commissions.
Yeah, but life insurance, you just have to look at it and say, and again, you peel back and you show them everything, right?
Yeah.
This is how I get paid. This is what you get. This is why I'm suggesting it, right? And if someone still doesn't want to take your advice, they want to do the other, then fine. Then I'll find you the best permanent product I possibly can and make sure it's going to do the best it can for you. But it's, again, 98% of the time, like term insurance gets you done.
Sure.
And we use a simple equation, maybe oversimplified. We'll say, look, let's take all the debts that need to be extinguished.
Right.
Usually 5 years of gross income.
Okay.
And that's roughly kind of the number that you're kind of looking for. You can have less if you have more assets accumulated and you want to lean on that. You can have more if it just feels better to have more, right? What I always joke though is I'm like, don't have too much, because when you have that argument with the spouse, then I'd be like, look, you're worth more dead than alive to me.
Yeah.
So,
I gotta figure out an exit strategy early.
be careful. Too much is dangerous.
Totally.
Yeah.
All right, last question I got here. So, a lot of people that come to me, they don't necessarily have a living trust set up, and that's, for me, that's huge. It's a great protector when you buy real estate to be able to put that property into a living trust. Let's talk a little bit about setting up a trust. People should have a will, of course. When you do pass, you want to make sure you've got that structure in place. So, what happens with your estate? Do you help your clients through that process? What does that look like?
Absolutely. So we are not an estate attorney firm. So we will not draft documents and we will not create the trust for you, but we know what types of estate planning tools are out there and what should be utilized. So a lot of times we'll start with a client and say, hey, here's the setup that you're going to need. We'll explain why. And then we'll either talk with their current estate planning attorney if they already have one. A lot of times they don't. We'll get them introduced again to someone vetted in our network.
Perfect.
That's a good personality fit, is reasonable on fees, all the rest of it. And we'll have them design that program. One of the things that people have to understand is every state is different. Every state has different estate tax and probate rules.
Sure.
California is a state where probate is expensive. Probate can be long, and it really behooves you, if you have assets of any import, to have a trust. Right. So just a real simple differences. If I have a will, my assets are public, right? It's going to go through a probate process. Anybody and their uncle can see what I own. If that doesn't bother you, no big deal. But a lot of people like privacy. Their neighbor doesn't want them to know, I've owned this house or these stocks or whatever. The second part of it is you've got to pay all the court fees. You've got to pay all the attorney fees, and you have to go through the process of probate, which post-COVID is now taking longer because it's harder to get into court, right? So if you have beneficiaries, children, et cetera, that need money, need bills to be paid, et cetera, that could put a little kink in it. When you have a trust, it bypasses the probate process. It keeps your assets private. Nobody gets to peep on them other than the executor, successor trustees, or beneficiaries. No one has to know what else is in there other than those folks. Right. And it because it lays out what's going to happen, it makes the process much quicker to get the assets where they need to go. On top of that, it's a much less expensive process, right? If you have a big estate, it could cost you 50, 100 grand to probate it. If you go through one of our estate planning attorneys, $2,500 to get the whole thing drawn up. I mean, it's the classic, ounce of prevention worth pound of cure. Right. So, and the last thing is, a trust typically is not about you. again, you're dead.
You're dead.
You're dead.
You're
Not
gone.
gonna matter. You're like, good luck.
Right.
But it's about the people or the entities, right? Some people don't have children. They want to give the money to charities or whatever the case may be. But it's
Sure.
about who you want it to benefit. Do you want to make that process easier, or do you want to make it really difficult on them? The final thing I'll discuss around that is, and here's the thing I bring up very regularly with our clients. A lot of times families, when they're setting up this trust,
Sure.
will want to have people they trust, whether it's siblings or good family friends, act in the role of an executor or act in the role of successor trustees. And that makes sense. It's perfectly logical. These are high trust relationships. You know, they're going to do what's in the best interest of whoever it is they're managing these assets for, et cetera. But it's a huge burden that a lot of times those friends, those family members don't know what they're signing up for.
Totally.
So a lot of times what we'll do is we'll say, hey, we'll get together, you know, again, our client with whoever the executor is going to be, right? We say, hey, let's have a call or let's have a meeting.
Have a meeting on this.
Let's walk the executor through what you have and what they're going to have to do, so they understand all the little pieces that they're going to have to go through.
It's intricate.
And then the executor can say, wow, like, I got a family and I got a full-time job and I live all the way across the country. And like, I'm overwhelmed just having this conversation.
Totally.
And we'll say, we get it. Here's another alternative. We have professional fiduciaries, right? People that you can write into your trust that when you pass away, it then triggers them to now go into action as your executor. These are people that only do this for a living, right? They know how the whole process works. They will take care of filing the final income tax return, estate return, getting appraisals on all the assets, liquidating any assets. Like if you need to sell homes or whatever as part of your instruction, I mean, they will take care of everything and get everything lined up for the beneficiaries of whatever that money is supposed to go. And a lot of people don't realize that, don't think about it. So I'm dealing with 2 estate cases right now where there are family members acting as executors, and I'm holding their hand through the process and I am helping them, and they're hugely thankful for it. But I can hear the trepidation in their voice when I talk on the phone. They're like, oh my God, when is this going to end? Right? When can this be over? So again,
it's a lot of work.
A lot of our job, a lot of what we do is, you know, tell you the truth, but also let you know what's coming before you get there. Right? So you can make competent decisions. Both parties know what's going on. Great. Move forward. Have at it.
Dude, I love it. This has been awesome, dude. Like you're such like your mind, the way you think and process. Like I appreciate you very much. I've enjoyed chatting for however long it's been, 30, 45 minutes. This has been fun, dude.
All day. Let's just quit our jobs and do this. This is way more fun.
Dude, this is awesome, right? Good little studio here. We're having fun. I think you're coming in a couple of days to hang out with the kids. You know, we're gonna have a fun day with the father sons, and who knows, maybe we'll flip the camera on and have some fun with the kids. But appreciate you very much. We'll have your information, you know, for people to be able to contact you. If, you know, for the viewers that have watched and listened in on the segment, we'll make sure they know how to get in touch with you if they have follow-up questions and whatnot. But just can't thank you enough, and look forward to continuing to work with you, Mike.
Thanks, buddy. Appreciate you. Thank you.
See you.